All right, folks, this is chapter 5. Chapter 5 from Brigham and Earhart. And this is just an awesome chapter. I mean, by the time this chapter is done today, you will see what the portfolio project that you're working on is about. There's an element of what Sean and Alan are going to talk about, the liquidity case. Some of my investment themes, my rants about ETFs, they're all bound in this chapter. In fact, some of the slides are very boring in this chapter. Towards the end, you will see the name Fama there. One of the slides has Fama on it. How many of you have heard the name Fama? Yeah. I've been talking about it many years, and you'll see Fama is right there. So until now, I used to say we do Sharp and Markovich, their works, as 2 Nobel Prize winning works in this class. Now we can add one more. Anyway, as you know, targeted homework, page 204, question 5.1 and 5.2. Page 205, problems 5.1 and 5.2d. All right. This is like a nuts and bolts chapter. There are 46 slides here. We're on slide 3. Suppose asset A has an expected return of 10% and a standard deviation of 20%. So that's your sigma. Asset B has an expected return of 16% and a standard deviation of 40%. So which asset is riskier? Asset B, 40% as opposed to 20% standard deviation. See, now we're bringing in the correlations, something that I sort of asked you to, if possible, keep an eye on while constructing your portfolios, but it was too early in the game for you to fully recognize what correlations mean for portfolio architecture and construction and subsequent performance. If the correlation between A and B is 0.6, now what is the correlation bounded by? It's bounded -1 to 1. 0 is a very interesting and important correlation. You basically want securities in your portfolio to have minimal correlation of about 0. If you have securities with a negative correlation, they're going to be like the shock absorbers in your portfolio. So if one of the securities doesn't do well, the other one is most likely going to do fine. And you definitely don't want securities that have a high positive correlation of, let's say, 0.9 each. So to translate some of this simple math stat kind of thing is like having Ford and General Motors and maybe Toyota in the same portfolio. That'd be highly correlated. So the question is, if the correlation is this, what is the expected return and standard deviation for a portfolio comprised of 30% asset A and 70% asset B? Now see, here's another element of portfolio management that you're seeing. There are more mutual funds in the US than their number of stocks. Number of stocks are about 5,000. If you include some others, it's 7,000, But number of mutual funds is about 10,000. Why is it? It's because of this, the weight. See, if you think about it, you can actually have infinite portfolios with just 2 assets, right? Anybody wants to give me a suggestion of a second portfolio? What would that second portfolio be? How about we just flip the weights? If you have a portfolio with 70% asset A and 30% asset B, wouldn't that portfolio perform entirely differently from the other one, You could even go short, So your weights are bounded, Normally in a long only portfolio 0 to 1, otherwise -1 to +1, And so you can even have negative weights there. So this looks like a very trivial and a simple problem. The simplicity continues here, looks like a formula, but this is basically intuition. The return on the portfolio and the hat indicates expected return. is basically the weight in asset A times the expected return in asset A plus 1 minus WA times the expected return in asset B. So in a way, if it's a two-asset portfolio, you don't even need to know WB, right? Because WB is directly 1 minus WA because of the budget constraint. Budget constraint is you add the 2 equals 1, 1 is equal to 100%. Everybody okay with that? So if you have $100, you invest 25 in Apple, the other 75 goes into Google, you know. As simple as that, if there are only two assets. Now if you start thinking about it, that's why people win Nobel Prizes on it. Extend this to a 500 asset portfolio, and then the computing starts cranking up. Now the simplicity is slightly diminishing here. I want to do that. Good. The standard deviation of the portfolio, this formula is not new, guys. We actually did that in chapter 4. It looks messy, but it's basically, WA, sigma A, the square terms. So it's basically A plus B squared. What is A plus B squared? It's A squared plus B squared plus twice AB. Just that. This 1 minus WA is actually WB. So the square of the weights in the asset times the square of the standard deviation, which is the variance, plus 2 times the weight in asset A times the weight in asset B. And this is where it's happening. This is where the correlations are reducing the standard deviation of a portfolio. Because if the correlation here is 1, then it's the same, then it's the weighted average. If it's not 1, then it has an impact of reducing the portfolio standard deviation lower than just a simple weighted average. Times the standard deviation A, standard deviation B. So in this case, you just plug in these numbers here and you get 0.320. Nothing much to do that. You can check it out. That is actually not the interesting part of this class. The interesting part are these slides here. And the associated Excel sheet. So this is like material that you sort of, is packaged in a book. And you get that. Now this sort of is hard to visualize actually. Because what I'm saying is, for a given correlation between two assets, A and B, of 0.4, which is 40%, what is the range of expected returns that you can expect as you change the weights from 0 to 1? So you can have nothing in asset A, or you can have everything in asset A. If that is the case, the expected return, so you can actually sit down and go here, and you can put 0 here for WA. Then you can just do 0, 0.3, 0.6, 0.9, and 1, and you'll see that your numbers, your expected return will change from 10% to 20%. That's actually from this equation here. And your standard deviation will actually change from 20% to 40%. Why it's difficult to visualize it is this. You don't see the weight on this plane here. That is the problem actually. So you're like, well, 0, where is 0? There's no 0 here. I mean, there is a 0 here, but that 0 is not the weight. That's 0% risk on the x-axis, and on the y-axis you have the expected return. We'll go back and, until I bring up the Excel sheet. When I bring up the Excel sheet, it'll all be clear. But let me just... The Deficient Frontier has different shapes depending on the correlation between the assets. So for every correlation, there is one efficient frontier for different weights. See? We're really talking in 3-4 dimensions here. So you got the risk return dimension here. But this shape of the efficient frontier, this is not a mistake. This is a little curve, a little dip here, which we can programmatically do. Actually, I have programs I have done that. But for correlation of 0.4, this is the shape that you get. This is the naive diversification case, where you're just diversifying by just adding securities which have very high, or in this case, perfect correlation. And naturally, as you see, that as the risk is increasing, the expected return is increasing in a linear way. If the correlation between the two assets is -1, you can actually find an optimal set of weights where the total risk is 0. The total risk of that portfolio is 0. So actually don't have to even draw a picture here. You guys are running a hedge portfolio. You got $50,000, go long SPY. The other 50,000 go short, DIA maybe, or SPY. SPY would be like a very trivial example there. Go DIA. What is the volatility of the portfolio going to be? Even if the market drops 20% next week, the net change will be 0, right? So those two are perfectly negatively correlated assets because of the short position there. So with that, you have Fisher-Black actually is called, he created what's called a zero beta portfolio, which is not a zero risk portfolio. It basically, zero beta means that its co-movement with the markets is 0. And then it touches the y-axis. What happens when it touches the y-axis? Your risk is here, which is 0%. And then you introduce a risk-free asset at 5%, and you have a straight line with the intercept at 5%, because the risk-free asset is 0% risk at 5% return. There are a couple of definitions here. One is called a feasible set of portfolios, and the other is an efficient portfolio. A feasible set of portfolios, it represents all portfolios that can be constructed from a given set of stocks. So those straight lines that you were seeing, that was for correlation 1. Anything in between 1 and -1, you'll have a curvilinear line. The space which is to the right of that is what's called a feasible set. So you can have a point here, let's say. A point here which is a certain proportion of assets that will give you this amount of risk and this amount of return. You can have a different proportion of assets. So just think of different weighting in Apple and Google, and that can actually bring you here or here. However, you are bounded by this, what is called the efficient set. You cannot go beyond this. So suppose, Apple generated 50% last year and Google generated 100% last year. If you have a 50-50 portfolio, you're just bounded by the numbers there. But the set of the combination of assets and the portfolios that are lying on this frontier here, they are a very special set of portfolios called the efficient set. Why is it the efficient set? Is because for a certain amount of risk, so if you drop a vertical line here, they're generating the maximum amount of return. Or for a certain amount of return, they're generating the minimum amount of risk. So any point here at this level of risk, that is the highest return that you can generate. You would be an irrational investor. Think about it. Let's say we drop a vertical line here, and you're taking this much risk. Why would you operate here? Why would you have a combination of assets that gives you this return? Once you have decided on taking a certain amount of risk, you will want to maximize your return. And so that's called the efficient set. So the efficient portfolio is one that offers the most return for a given amount of risk, or the least risk for a given amount of return. And this collection of efficient portfolios is called the efficient set or the efficient frontier. I'll make this real very quickly. It's this paper which you are not doing in class just because it came out just before class. I mean, this is, I would think this is my best paper so far. It just captures all of this and a few other items. But you have access to the paper. This is the paper for which I was given a copyright violation on my own paper by these same guys. And so then I said, hey, this doesn't make sense. So they made a custom. I don't know, some of you may have seen it. If you click on the link, it's custom University of Maine download. How many of you have seen that? Only one. Interesting. I'll show that anyway. But you see these pictures here? They are actually real. I mean, it takes a lot of CPU time to generate them. This MAC, as you know, MAC stands for multiple asset class assets. This includes the 6 asset, this is the 6 asset ETF. The United States, emerging markets, Europe, and then gold, real estate, and bonds. And so what you see here is if you invest, this is the all equity frontier. Look at that. This is a loss function. This difference is the loss that investors are dealing with without knowing about it. They are bounded by this blue line here. This is an all equity frontier. Russell 1000, the top 1000 stocks, they're limited to this here. This is the MAC assets frontier, where you take different combinations of those 6 assets and you have this. And if you think about it, this actually dominates. It's called dominates actually. This is a total envelope of this. And this is what this paper is about, is the 1 over n approach. The 1 over n approach is just a fancy way of saying equal weighted, you know. So if you have 6 assets, 1 over n is 1 over 6, that's what, 16.67%. So all you have to do is 16.67% in each of the assets. And of course, it will never be able to perform as good as a Markowitz style mean variance action frontier, but I'm not expecting investors to go and do an MVO, it's called MVO, Markowitz mean variance optimization. But the point is, it is still superior in both higher amount of return and lower amount of risk at any point on this. So I mean, it's big too. I mean, this is big. And I know we all have too much information. It's actually number 1 on the most downloaded paper, most read paper on the journal's website. So this is actually the actual. This is an all equity portfolio. So this is like real. This is not simulation. The MAC portfolio's empirical performance is shown. All portfolios outperform the market, which in this case is a Russell 1000. So this is your Russell 1000 here. The red one is the mean variance optimization multiple asset class. And the blue one has higher volatility. Sure, it's not as sophisticated. It's not as sophisticated as a mean variance optimized portfolio, where the weights will change. They're not going to be 16% each. But as you can see, it is still superior to just having a single asset in there. And then there are some other things. I'll actually do something. See, here's the correlation matrix. See, we talk about correlations here. So here's the correlation between EFA, which is Europe, Far East, and Australia, and emerging is 0.89. With US is 0.94. With bonds is negative 0.43. With real estate is 0.69. With gold is 0.204. And the diagonal elements are all 1 because that's the correlation between each is 1. And the off diagonals, you don't bother publishing them because they are actually the same. The correlation between EFA and EEM is the same as between EEM and EFA, just that. So actually really simplified things. So here you can actually see, so actually producing numbers. So we have the theory, we have the simulation, and we actually have actual numbers. So it's right here. These returns are over the period from 12/2004 to 5/2013. So now you know what bank was doing in the month of May, just as semester finished. Sent my family home to their grandparents, and I was cranking it out here. I was very happy. I like it when I build things. I really do. Here are the annual returns here. So annual returns for the EFI index is 4.4. For emerging markets, 9.6. Russell 1000 is 15.9. Gold is 14%. And then somewhere in here are the returns for the portfolio. You can see that. You can actually download this paper. It's actually totally legitimate download. One other reason I just brought this up is we will look at this here. Is one of the reasons it's getting some interest is Richard Roll, and I think I mentioned his name. He will win a Nobel Prize one of these days. He's a very senior professor at UCLA. He does his aeronautical engineering in Auburn, Alabama, worked for Boeing in Washington, did his PhD in Chicago, and I mean, he's just... So what I'm saying about the MAC portfolio is, let me read this actually. This article seeks to extend classic investing, which is often limited to only domestic equities or to a mix of equities and bonds. So, among investors, those who are slightly more careful and sophisticated, they throw in some bonds. But even then, they're limited to bonds, to a wider array of lower correlation non-equity assets. The ready availability of highly liquid index exchange traded funds, and Mr. Doherty and Mr. Sean, they're going to talk about that today, on assets such as domestic equities, international equities, bonds, real estate, gold bullion, and foreign currencies has the potential to extend our availability set and the resulting risk-return efficient frontier beyond what is possible with only equity portfolios. Now this is where Markowitz stopped. Markowitz did a lot of optimization, but all his optimization was within the class of equities. So what percentage in Google, what percentage in Apple, what percentage in Ford. Here, I literally took the ball out of the ballpark here. It's like we are still being constrained by that box thinking of all equities. And then I invoked a very big name. This could take us a step closer towards meeting the all-inclusive but elusive true market portfolio, Roll 1977, and thinking out the equity box. We'll go back to our PowerPoint slides, and one of the criticisms of the CAPM, so not everybody can criticize the CAPM because the sharp written black CAPM, but Richard Roll can. Richard Roll said, the CAPM cannot really be tested. You're using a proxy, which is S&P 500 as the market, but the true market is unobservable. Why is it the S&P 500? Why not the Russell 1000? Well, why not the Wilshire 5000? Wait a minute, is the world just the United States? Why not all world equities? Wait a minute, what about the non-tradable assets? What about that little shop in Tokyo, which is generating some revenue, you know? So it's impossible. Roll's critique said it's impossible to measure the true market. So if it's impossible to measure the true market, it's impossible to test the CAPM. That's called the famous Roll's critique. Investors stand to gain from the additional diversification made feasible by extending into a multiple asset class portfolio-based covariance matrix, and then other stuff. But anyway, that was just show you that part there. So as you see now, see this boring or this whatever, you know, frontier here, you've actually seen a live application of that. This, if you think of it, these little sort of bumps or curves or whatever you say, these are the sub-efficient frontiers there. So think of it. On that paper of mine, you had the Russell 1000. This is an all-equity efficient frontier. And this is the dominating efficient frontier. But within 5 slides, I will show you how you can actually even get beyond this. Get into this white space here. But that's another sort of topic. All right? I'm just debating in my mind. There are two things I can do right now. I can go into this, or I can get it in Excel. Let me show you, let's actually do something real. And then students like that. It makes it. So I took that question that we had at the beginning of the slides here, of the chapter. And if they're slightly different, you can change them. Yeah, they are actually. It's fine though. Expected return of security A is 13%. Standard deviation is 20%. Security B is 8%. Standard deviation is 12%. The correlation coefficient, I say, is 0.2. Start with 0.2. Can we build an efficient frontier? Sure you can. You just have to, take an interest in, just some simple formulations and all that. No coding is required in this one here. So percent of portfolio in A, you can start from 0%, right? I mean, this is see how simple it is, 0 to 5. I mean, of course, you can go 0.1, 0.2, 0 to 5%, 10, 20, and all the way up to 100. Everybody okay with that? Then you can calculate the expected return. How I calculate the expected return on slide 2 is right there, is here. B27, here's B27. Right here, 0% times B4, that's B4, the expected return on security A, plus 1 minus B27. What do you think that'll be? That'll be the weight in security B times B8. Everybody okay with the dollar sign? I'm not going to ask this on an exam and stuff, but it's, Wall Street runs on Excel. I don't expect or want that all of you work on Wall Street. But you can use Excel in many different things, to manage your inventory, to manage an electrical supply store, anything. So the dollar is like an absolute reference, basically. And why I'm doing that is then I'll just drag it. You think I'm punching all these numbers by hand? No, I just do one or two of them. And then does that. So here's 8% with 0%, and 0% in A. And then this is 8.5%, and so on and so forth. Fine. This is the messy calculation here. Here's your standard deviation. Exact translation of what you have on slide 3, okay? You take my word on that, you can actually do that. And where is this cell? B. Let me see. B11 is where the correlation is. Go under review, and where do they have trace precedence here? Where else trace dependence? There you go. You see that? So when you have a sheet and sometimes you have to debug them, this correlation is feeding into each of these numbers. Now I can set up a simple simulation to illustrate the impact of changing correlation on the efficient frontier. So you can just go here and remove arrows, So this is like trace dependence. In case, sometimes you have to debug like semi-complex sheets and all that. It's under formulas, trace dependence, and trace precedence here. So if you go here, I think trace precedence are going to be what's, so the outcome is a function of a number in this cell, this cell, this cell, and this cell. So if you go here, trace dependence is going to be there. Okay, so one goes to the left, one goes to the right. Drum rolls. There you go. Thank you. -1. I mean, because it's discrete, the weight change is discrete, it's like in increments of 5%, it didn't touch the y-axis. But if you make it, more continuous, this would touch the y-axis. And you'll see, I guarantee you, it's going to be a straight line. See? Look at that. the amount of risk minimization is decreasing as your correlation is increasing. I cannot show it any other way. You guys, hopefully, I like that smile on your face, Alyssa. It means some message is going there, right? You're seeing this in your portfolio maybe. A lot of messages. Very nice. I have unlimited text messages. Feel free to text me. I like it actually. When I get text messages from my students, I like it. I'm actually scheduling my undergrad advising. The guys come tell me, say, Pank, you know what, you don't keep us on hold, you know. This guy sends me a text message, boom, I say, 1:30 tomorrow, come there. No problems. It actually hogs my space. If I have an unanswered email or text message, it actually hogs my space in the mind. So I try to, get it done, But look at that, guys, here. Isn't it, to me, there's some beauty in this. Look at that. As I get closer to 1, the correlation coefficient is greater than 1. This is your bound here. Your risk, remember, risk is on the x-axis. It's not going below 10%. So easy. So easy to reduce the risk. Look at that. You're going to the left of 10%. More. There you go. Let's do something a little more interesting, actually, in case you thought this was it. There's a very special point on this. This point here this is called the minimum variance portfolio. So I'll show you the slides. You guys can read the slides actually, but this is a minimum. There are two special points here. This is called the MV portfolio, minimum variance, and this is called the tangency portfolio. I haven't got into that, but as you know, I can only speak so many words at any given instant. So I'm trying to demonstrate it using Excel here. Is this point here, this minimum variance portfolio, look at that, I'm hovering on it. What do you see? 11.19. The mind tends to read the first one as return. The first one is risk. 11.19 right here. See, I got this line here, sort of magically. Of course, I can go through this and ocularly determine the minimum variance portfolio area. Look at that. At 0% on A, my risk is 12%. As I put 5% of A in the portfolio, the risk drops to 11.64. See, there's a theme in the numbers. Right, Josh? You see that, right?
Yeah.
There is a theme there, guys. This is really, I don't want to say serious, this is good stuff. 12%, 11.6, 11.3, 11.1, 11.19, notice, 11.11, low, 11.14, 11.26, 11.48. An inverted U curve, U shape there. If you rotate it 90 degrees, an inverted U. What is happening? Somehow, this is a minimum variance portfolio. Now, this is too much work for me. I don't like to do this kind of work. So how do you do that? You can invoke the solver in Excel. The solver will change the various cells that you put in there and give you a calculation there. So let's say the correlation coefficient, I'm going to break this sheet here, 0.4. See, just so you know that it's real. And then you go into data, solver. Sometimes it may not be, this add-in may not be there. And so you have to go into Excel options here, preferences, and you're going to add solver and all that from here. I mean, this is something you guys can figure it out. Hit the solver button here, and it says set objective F6 to a minimum value by changing F9. By the way, Sean, they have changed the new solver. I don't think it has the Newton's second approximation there anymore. You see that right here? I'm looking at it myself here, sort of for the first time, second time actually. So they got these three algorithms here: GRG, nonlinear, simplex, linear programming, and evolutionary. So if you go to Excel 2007 and below, that's where you're going to see the Newton's conjugate or the Newton's second approximation there.
So it doesn't give you, can you add it on? Can you add that on?
I think there's a company called Vertex LLC, I think, or something like that. You can do that, But so let's go in solver here, and notice. So remember F6 and F9. What is F6? F6 is here. And guys, don't try to absorb everything. Just because I've shown you the sheet, this can be quite a bit. I'm not going to ask an exam question from, but there's actually a lot. There's a lot of power, and then you can extend it for your own purposes. So F6, I'm saying minimize the portfolio variance by changing F9. Notice. So I'm telling the solver to minimize portfolio variance. Why? Because we don't like that. It's like minimize garbage. You don't want garbage in your house. If you have some method by minimizing garbage, you'd like to do that. One way we figured out how to minimize garbage is by changing the weight in this security A until we have a minimum variance portfolio. So let's run it and see what happens. Remember, I changed the correlation coefficient to 0.4. We should not get 0.21 here. That's what we're looking for. Solve. See, it took some time. Did you notice that? Keep the solver solutions. 0.14, the weight and asset in security A. Now 0.14, this is not here. This is 21% in asset A, so it's right around here. Why? Because this minimum variance here is for correlation coefficient of 0.2. Now let's put 0.2 here. And I guarantee you, it will. What it is doing is it's changing. If you think about it, it's changing the weight here. It's changing different weights. It's going through every weight, every possible increment between 0 and 1. I mean, not every possible that be infinite, but in some small increments until it finds a minimum. So think of the power of that. And you'll notice it will take some time. See? And this is a really fast chip in there. It took some time. Why? It literally scanned through all the weights for me. That ocular scan that we were doing, it did it for us. And notice the answer should be, 0.21, the weight in security A, which is basically what we have determined here, 0.21. How do you like that? You see? Now, professional investment management software, this correlation here that I have here is replaced by a 50 by 50 matrix of cross correlations. And that's where there is, in the first part of my paper, I've actually given a mathematical solution on how you can use the determinant of that matrix to just actually work off one number. But that's a whole different topic there. So guys, you can play around with it, but also you're actually seeing in action what are usually, because I used to struggle with it. When this topic was taught to us, it wasn't as sort of like, those were classic slides. Nobody frankly showed, how it's actually done. It was a mystery, But I don't want anything to be a mystery coming out of my class. And see here, so weight and asset A. So here's the result of the optimization here. 0.21, 0.79, someone ends up to 1. The standard deviation of the portfolio at this point is 11%, and the return on the portfolio is 9.07, which, when you go back here, is exactly pretty much right here, 11.19, 8.75, right there. This is an optical solution. This is an exact solution there. So I feel comfortable that I've given you a close-bound, explanation of some of this here. It's like a fun thing. What is the square root of 25%? What's the square root of 25%? 5%? No. 50%. Because, yeah, 25, square root of 25 is 5, actually plus minus 5. But the square root of percent is 1 over 100, so that's 1 over 10 actually. So it's 5 divided by 10, that's 0.5. 0.5 is 50%. They actually asked me this question when I came here for my faculty interview in 2005. Bob Strong asked me this question while having lunch, just threw it at me. I'm like, what? It was fun.
Did you get it right?
I think so. I did. Actually, there was an operations research professor. She's not here. She's a very smart person, she was. She left. So now, guys, now it'll be a lot more clear. Let's zip through this here. Here's your efficient frontier. These are your feasible frontiers. These are your feasible portfolios inside any point inside. In this particular case, we are looking at something from a microeconomics, something called indifference curves. So for two economic agents, B and A, they have indifference curves. An indifference curve is the agent is indifferent along any point on the curve. And so for agent A, this is the point they will choose. So this actually is linked to a set of weights. But what you see actually is this investor is comfortable with this amount of risk and this amount of return. This investor likes a higher amount of risk and expects a higher amount of return for that. And the utility always increases in this way. That's something different. So the CAPM, now we come back to CAPM. We thought we had done that. Now it's going to make more sense, hopefully. It's an equilibrium model that specifies the relationship between risk and required rate of return for assets held in well-diversified portfolios. It's based on the premise that only one factor affects risk. See, this is where the next Nobel Prize is going to go. Only one factor affects risk. What is that factor? Market risk. The returns, according to the CAPM, the returns on most assets are a positive linear relationship or a positive linear relationship with market returns. And that is captured by beta. What are the assumptions of the CAPM? All investors think in terms of a single holding period, they have identical expectations, and they can borrow or lend at the risk-free rate. Now look at this here. This is where I'm relaxing. It's called relaxing some of the assumptions. And you are ahead of the guys who wrote this book and this theory. All assets are perfectly divisible. Are they? Can you buy me 0.2 gallons of milk? How about 1/3 of a Chevy? 0.2 of a house? 1/5 of an airline seat? Remember, now it comes where I was sort of like, please buy your shares in round lots of 10. A mutual fund you can buy as 21.1 shares, because it's an accounting adjustment. But shares, you buy them in round lots. Odd lots, round lots. So you are relaxing this assumption. Assets are perfectly divisible. There are no taxes and no transaction costs. Very, very convenient for academics because the math gets pretty messy. But that was then. Nowadays you have computing and all that. The drawing of the efficient frontier, the tracing of the efficient frontier that I did in front of you, I don't know how difficult that would be, 30, 40 years back. But hats off to those guys, who figured it all out in the 60s. You guys have taxes and you guys have transaction costs built into your portfolio. All investors are price takers. That is, investors buying and selling won't influence stock prices. Oh, really? Warren Buffett and Fidelity buying and selling has no impact on prices. How about you flip 100,000 shares of some illiquid ETF that these two gentlemen are going to talk about today? That's liquidity right there. That's how you do research, Sometimes you think, it's like, what other idea can be? Everything that needs to be, life is comfortable. I got my shirt, my shoes. What is there more to do? All the medicines are there, CAPM model is there. It establishes a relationship. You start getting into the finer, start chipping at what you take for granted, Like, how much more fast would a modem go? I accept apologies to Mr. Doherty. Apart from him, I don't think any of you guys have used. I have used a modem with a wire in it, 2400 baud, right? Where did you start off with? I started 2400 baud, Yeah, 24, then 58, and then 128. We were very excited when US Robotics came out with 128.8. And then someone said, let's just do away with the wire, No more wire. You had to plug the modem into the computer and through the phone on top of it. I remember Microsoft executive in 2007 saying that the bandwidth required for delivery of video over the internet is just not there. TV and video cannot be delivered over the internet. Clearly said that in 2000. Clearly. Now you get high definition, right, on your phone. Quantities of all assets are given and fixed. Okay, sure. So anyway, that's the liquidity paper that's going to happen. The next few slides, folks, are going to build up to the most amazing concept in finance. So here's one slide. 1, 2, 3. So bear with me. 4, 5. And this is that concept that I'm going to show to you. See if I can change the color here. Guys hesitate using pink. I on purpose use pink, Right? Why not? What will it do? Now introduce the risk-free asset. What happens then? When the risk-free asset is added to the feasible set, investors can create portfolios that combine this with the portfolio of risky assets. Remember, every asset on that curved Deficient Frontier is basically a risky asset. RA, RB associated with asset A and B. The straight line that connects RF with M, which is the tangency point between the line and the old efficient set, becomes the new efficient frontier. Like this. So just when I finished mentioning that the investors, they are trapped inside this ellipse. It's actually an ellipse. Richard Roll actually has a paper where he has an equation. This actually goes all the way here. It's an ellipse actually. The set of feasible portfolios. Each one of them, each point actually is a portfolio, WA, WB, and you can have many. This point of tangency between this line that starts at the risk-free asset is called the market portfolio, and this is the risk-free asset here. By the introduction of a risk-free asset, the new efficient frontier is actually a straight line tangential to a certain point on the efficient frontier. These points are very significant. This line, by the way, is going to be an important item, so just make a note of it. It's going to show up in homeworks and other places. It's called the capital market line. Students often confuse between the security market line and the capital market line. The security market line has beta in it. The capital market line has sigma in it. So the risk is total risk here in the capital market line. The security market line is a relationship between expected return and beta, whereas this is the relationship between expected return and the total risk of a portfolio. The capital market line is an all-linear combination of the risk-free asset and portfolio M in the standard deviation return space, not the beta return space in the security market line. All portfolios below the capital market line are inferior. And so the CML defines the new efficient set. And so what is going to happen is all investors will choose a portfolio on the capital market line. Some of you are wondering, well, Pank, why is that going to be happening? Of course, there's a rigorous mathematical proof on that, but I'll give you just a visual on that. I actually gave you a hint of that, but there's only so much I can do in class. Is investors, they increase their utility by going north-west. So IA2 has higher utility than IA1. And so if you think of an investor wanting to go northwest, where will she end up if she starts from somewhere in here? She would like to not go below this line or to the right of this line. So the efficient frontier just got extended. So this is sort of, we're gravitating towards an amazing revelation almost. It's just by the introduction of a risk-free asset, we have broken free of the efficient ellipse that we have. So that's where that line is there. All investors will choose a portfolio on the capital market line. And here's the capital market line equation. There's no new information here, guys. Nothing to be, it is pretty much like the security market line. You replace the beta, which is risk, systematic risk, with total risk, which is standard deviation of the portfolio. RM minus RF stays the same. And this actually sigma m is just standardizing it with risk. And you can actually do, it's actually sigma m minus 0. Why 0? Because that's the standard deviation of the risk-free asset. And so that's your slope. Plus the risk-free rate is the expected return of the portfolio. And it comes straight from a very elementary, the equation of a slope, y equals a plus bx, where b is the slope. And what is b? B is rise over run, which is basically change in y over change in x. See, I'm not just throwing it in there. This delta y is actually Rm minus Rf, right? Because that's your movement. Rm minus Rf, that's your change in y. What is your change? So that's your rise. What's your run? Is sigma m minus 0. Like we draw a line from here, sigma m minus 0. Why 0 here? Because the risk of risk-free is 0 here. And so that's why, from this, it comes to this. So actually, this line here is basically y equals a plus bx, where x is your risk measure. And once again, the expected return on a portfolio is a positive linear relationship of your total risk. That's the capital market line equation there. What does the capital market line tell us? And this is the line, this is a slide which has that extraordinary piece of information, which probably not everybody knows, especially those who are not trained in the area of finance. Item 1, the expected rate of return on any efficient portfolio is equal to the risk-free rate plus a risk premium. Fair enough. The optimal portfolio for any investor is the point of tangency between the capital market line and the investor's indifference curves. So here's another thing. See, this is why I said, what investing is like, and I'm not like that, but I'm just saying, it's like about your God versus my God. There's no perfect portfolio. It depends on your risk tolerance. It depends, and your risk tolerance is a reflection of your indifference curve. Different investors have different indifference curves. Wherever they touch the efficient frontier, that's their portfolio that they're happy with. And guys, here, this is the big ticket item. This is called the two-fund separation theorem. Thus, RF and market and the market portfolio M will produce the most efficiency, and thus investors will hold it in combination. And that is all they need to hold. So you had hundreds and thousands of assets, and you had an efficient frontier. This is M, and this is RF. Investors will move between these 2 points. All they need is basically 2 assets in their portfolio, RF and RM. And yours truly has simplified that to SHY and SPY. And everything in between is just a waste of time. There you go. M, that's your market portfolio. That is the SPY. RF is SHY, which is there. How many of you have posted the tracker and played around with it a little bit? I know Heather has. You guys should check it out, guys. I mean, really. I mean, you'll know exactly what your performance is. You'll need those charts for your final portfolio projects. It'll give you year-to-date numbers. You can do back test, stress test, everything. And it's like all you have to do is just literally open it. I know opening the thing is always the problem. It's like, as someone said, that just getting there is 95% of the battle. You're just showing up for work is 95% of the battle. Showing up for work on time is 99% of the battle. You know? And just open that Excel spreadsheet. Open that Excel spreadsheet. All you have to do is look at your portfolio holding report, type in the ticker, type in the dollar amount. You don't even have to type in the beta. Heather, I noticed that you overrode the formulas actually. You did a lot of extra work. Those betas, you typed in the betas, right? You didn't have to type in the betas.
I think I did.
No, because all those you killed all those formulas in that sheet. You typed in one beta each time.
Killed them. How could you kill them?
Yeah, overrode them.
No idea.
She overrode them. In the third row of the front sheet, she overrode all those formulas. And poor Heather, she went and plucked each beta by hand from the third sheet and brought it. No, there's an HLOOKUP formula there. It automatically pulls it in. That's why I think, Bob, when you tried to put in econ as your new ticker, it didn't bring it in because there was no beta associated with econ. Because the betas are not being pulled from the web, if you notice in that sheet. Because that's the whole thing. The web betas have a slight problem, right? So we calculate our own. So I have to run a program, put those betas on the third sheet, and then go with that. But anyway, in that sheet, how did I get there? In that sheet, you have SPY and SHY as your benchmark, and this here. So if you think about it, folks, an extremely risk-averse investor is going to be on this end of the capital market line, right? Just nodding your head. Why? They're going to be, what is their portfolio going to look at if somebody is operating on this here? 100% risk-free asset. If they're slightly more adventurous, they're going to start moving up. There is no advantage to an investor in terms of risk-return space to having more than 100% of their capital invested in equities, and for which there is one portfolio, the market portfolio. In fact, and this goes, you can actually do leverage. If you are operating on this end of the capital market line, you are in leverage. How can you have more than 100% of the market? By leverage. So then you are in leverage on this side here. So this is just, XY plane is just amazing. This is just really amazing, the two fund separation. And we have come back full circle here, guys. You are watching your portfolios, you're watching this, watching that. And it's basically, what is your combination of RM and RF going to do? Think about it. With the beta of RF is 0. The beta for RM is, or the beta for M is 1. As you alter the weights, your market risk is going to change. Your portfolio risk is going to change. And your return is going to be a function of that. Just that. How much market risk you take. See here, right here. So for this particular investor, this point is the optimal portfolio. What is the security market line? The security market line, so the capital market line gives the risk-return relationship for efficient portfolios in the sigma R space. The security market line, also which is a part of the capital market line, gives the risk-return relationship in the beta R space. Just that. That's the primary difference. The SML equation is this. You know about it. RF plus risk premium. This is risk premium times beta. Risk premium is RM minus RF. How are betas calculated? We know all that. Run a regression of past returns on stock I versus returns on the market. And the slope coefficient is the beta coefficient. You've actually done this. So here's your RM, which is your X variable. Remember, this is sometimes you make a mistake. Not you, but the market is not the dependent variable. The market is the independent variable. It's the one which drives. The market is the ocean. You are the boat. A small boat or a big boat. But you are the boat. Your flotation and your speed and your pitch and your roll is going to be a function of what is happening in the ocean. There's no escaping that. People may think that they're escaping that, but there's no escaping that. There have been a lot of social experiments done in that. It's very interesting. Actually, a friend of mine, I think I may have mentioned him in class. He's actually one of my really good. He has a PhD in psychology. He works for a leading market research firm in Los Angeles. So we chat over the phone sometimes and all that. He says, Pank, it's interesting that the recent Nobel prizes in the area of finance are going to people with an interest and specialization in investor sentiment and cognitive dissonance in psychology. 2002, Startman. Now, 2013, Schiller, who wrote a paper in 1981 about that, that the short-term fluctuation in prices of assets has to have some element in it more than just the fundamental variables of economics and finance. And that variable is investor sentiment. So how do you calculate it? Now we see, look at that. Look at how elementary these slides are. After the papers that you have read, this is like, oh yeah, sure, we know that, right? Look at that. 1 year, 3 year, monthly returns. I mean, we even know the difference that will happen if you use daily, monthly, weekly, 1 year, 5 years. Basically, beta equals 1 is the average risk, which is also the market portfolio. Interpreting regression results. Yeah. Just so you know, if you don't do a portfolio-based regression, if you do a security-based regression, so suppose in your column you have the top 500 stocks, and then you have the market return. If you do that regression, the best R-square that I have seen is 0.14. That means only 14% of the variation in your stock returns can be explained by the market. So it's very difficult. Not difficult, it's just there's so much variability. At the portfolio level, the R-squares, they increase. See, the typical R-square is 0.3 for individual stock, is over 0.9 for a well-diversified portfolio. The 95% confidence interval shows the range for beta. For individual stock, is 0.5 to 1.5. For diversified portfolios, is 0.92 to 1.08. And therein, that's the reason why sophisticated investors are nowadays doing ETFs, because ETFs are natural portfolios. There is more predictability about it. I mean, you're operating in a world of uncertainty anyway. But by combining it, if you can increase your R-square, look at that. From 0.3 to 0.9, that's huge. The relationship between standalone market and diversifiable risk is actually covered in chapter 4, that basically your total variance is broken down into the market risk and the diversifiable risk, or the unexplained risk. That's the epsilon. Epsilon is the error term, the unexplained risk. That's where I've actually used that. Some of you probably know that I had to start a company to release my app just because of liability reasons. The name of my company is Cloud Epsilon. Epsilon, which is, what is epsilon? Let's see. Some fun stuff also we should do every now and then. Cloud Epsilon LLC. See, I got Google presence. If you type something related to me, I got like 6-7 pages on Google. Epsilon, the most influential yet often the least understood variable in our modeling environment. We recognize the power of the epsilon. This random term can rapidly alter the steady state equilibrium in a system of equations. It moves with the cloud and also moves the cloud. And yeah, so that's that here. There's some fun stuff here. You can read about it. But look at it. I mean, this can be business law here. Go into the site user agreements. I mean, I had 2 corporate attorneys, helping me draft this. Still haven't recovered, the cost of the fee for the attorneys here. Terms of service, indemnification, external risk. Every word here I know here, guys. I've done this. Refund policy on a 99-cent app is there, okay? Because somebody will get really upset. It's not working. I mean, really. copyright, there's that, everything. So it's like a whole. It's like we're in a class of finance, but this is literally launching a company and what goes behind that. Some of those things. But how did I get that from? I got that from here, right here. There's epsilon. The variance of the error term, which is a diversifiable risk on the stock. So this part cannot be modeled actually, but the epsilon term is the most important term. If you go and look at some of the short positions that you guys have in your portfolios, it's epsilon which is driving that return, because everything else was understood. That was factored in the market. What really moved that particular stock? So Facebook, so here, see, this is where I go off, not on my tangents here, but this is what I like about this material, is I'll show you 101 examples here of epsilon. We talked about this in class, right? Why would you buy something that is $890? That looks too expensive. That's another topic. It's like, are higher price stocks more expensive? That's another area of my research I've been thinking about for many years. It's not actually. In fact, I had a poster on that. It's actually low price stocks are actually more expensive. If you look at the fundamentals, price to sales, price to earnings. It's all in the perception, guys. We are human beings. It's all how we see things. There's a $900 stock there for you. How would you like to buy it at 1,000? There you go. Epsilon. You know why it's epsilon? If it was not epsilon, there would have been a positive drift. People would have known that there's some good news going to come out of it and would have drifted up. So it was totally the random, and we really minimize the impact and the element of randomness. Same thing here. Facebook was being written off. I mean, look at that. There's epsilon right there, right here. Right here is epsilon happening. It was drifting flat to down. And it doubled its value from $29. Well, not double. 29 times 2 is what? 58. It's around 50. 54. Yeah, sure. Why not? So there's lots there, guys. There's lots. It's a very deep ocean, as I say. This is an exact formulation here. Beta is a factor of the covariance between security J and the market divided by the variance of the market. The covariance Jm, this is notational, can be expanded as the standard deviation of J, which is a security, times the standard deviation of the market, times the correlation between the security and the market, divided by the variance, which is sigma m squared. So you see one extra sigma m can go away. So thus beta, you can get this on homework or something like that. Beta is correlation times the standard deviation of the security, correlation between the security and the market, and standardized by the variance of the market. Just that. It follows from the market model, which you can see on that page. What are the two potential tests that can be conducted to verify the capital asset pricing model? One is the beta stability test and test based on the slope of the SML. Now see, some of you are dealing with this or thinking about it. It's like, okay, we got Pank betas or we got betas from the web. But that was September 15th or 17th. What now? That's like one semester of a master's or graduate program, All I'll tell you is it's called betas or non-stationary with a slight drift. Which means beta month to month will change, but the change is very small. You do not expect that the beta of IBM is going to go from 0.5 to 1.5. But as management of IBM changes, small things change, can go from 0.5 to 0.6 to 0.4, something like that. So beta, there's a drift, there's non-stationary, but there's a small drift there. So tests of the security market line indicate there's more or less a linear relationship between realized returns and risk. That means basically the English translation is that as realized returns, as market risk increase, the realized returns increase. Notice I'm saying realized returns. It's one hell of a statement. Basically means that if you hold a higher beta portfolio over a sufficient period of time, your realized return should be higher. However, in a great paper by PSM 1995, I actually had the privilege to meet all three of them. They're from a small college in Kansas. It got the Best Paper of the Year award, Journal of Financial and Quantitative Analysis. Pettingill, Sundaram, and Mathur. Three guys. Glenn Pettingill. Says the slope is less than predicted. So if the predicted slope is like this, it's actually flatter. That means you expect that as beta goes from 1 to 2, your return also goes up in that same proportion. No, the gearing factor is not that much. So having a higher beta portfolio does not necessarily translate into an equally higher amount of returns. Slightly higher, yeah. Irrelevance of diversifiable risk specified in the CAPM model can be questioned. So you guys are very nice to me, which is, I appreciate that. But at an academic level, you can challenge me. As a bank, you're saying that the only relevant portfolio is the market portfolio, but I know a couple of guys who had Apple in their portfolio. They beat the market. They're doing great. So that is what, there's a whole group of investors out there. They're basically called fundamental investors, in the institutional portfolio management space. And that's fine. Everyone can live under the sun. It's fine. It's about their God versus my God type of thing. They believe that the market is not efficient. Fama got a medal for market being efficient. There's a market's not being efficient. I know what the next Apple is going to be. I know what the next Google is going to be. So I will actually take diversifiable risk. I will actually hold it. I will not cancel it out. I will not cancel my next Apple and Google by holding garbage stocks, Because when I hold the whole market portfolio, I'm holding some garbage stocks, right? But that's theory, and then there's practice. Results show something.
And that's simply level of risk that they're willing to accept.
What's that?
It's just their level of risk they're willing to accept. Right?
Yes and no, Sean. I'm very glad that you brought it up. See, we have covered enough territory where you have to be specific. Theory says is the level of market risk that you're holding that is relevant, Your return is a function of level of market risk. Holding diversifiable risk does nothing to your expected return, But they are holding diversifiable risk. If you're holding five securities in your portfolio. But they're holding it because they think there's alpha there. So this is just the net. This is like 2 semesters of graduate work here. Betas of individual securities are not good estimators of future risk. How many of you have sector spiders in your portfolios? Like XLPs, XLVs, XLFs, almost everyone, right? Don't you think that you have a greater belief and confidence in the beta of XLF than just the beta of Wells Fargo or Bank of America or Goldman Sachs? That's basically what that bullet point is. So betas of individual securities are not good estimators of future risk. However, betas of portfolios of 10 or more randomly selected stocks are reasonably stable. There's a lot of research done on that. Look at that, guys. Hence ETF growth. ETFs have exploded. How many times you guys have seen from 10 assets in 1998 to 30 in 2000 to 200, and now you guys update me with the numbers. As you know, I've written the ETF papers, but I'm also losing track how many ETFs there are. Past portfolio betas are good estimates of future portfolio volatility. I actually take this as segue to show you that I drink the Kool-Aid that I'm dishing out, as you know. Here, go to JII here, and look at how many papers you have on ETFs. And this is the journal that's there on every desk at Goldman Sachs Asset Management and so on and so forth. So this is a current issue, and this is a list of contents here. Revised survey on leverage and inverse leverage ETFs, low volatility investing, the risk of volatility ETNs. We didn't even get into that. These are exchange traded notes. These are the next generation of ETFs. So you had the cell phones and then the smartphones, the exchange traded notes. And this is yours truly here. ETF asset managers, ETFs within institutional managed portfolios. Why don't we do this just for fun? Most read in the last 30 days. Just for fun. Oops, went to the wrong page here. There you go. This list goes down to what? 2000 and I'm happy about it. I'm sharing my happiness with you. Why not? 2010. Bringing research into class, it keeps it current. I mean, it's really. See here, David Blitz, Fundamental Indexation, 2010. So this is like, they track, these are actually paid downloads. Each paper is like $99. So paid downloads, and not the paper ones, just online. From 2010, that's right here. So editor's letters downloaded 9 times. And here it is. Not bad. Paper that came out 2 months back. But you can actually download it free. And it seems like you guys haven't seen that link. I don't know how to show that to you. Where would I bring that up? Have you seen that?
It's on the first class.
It's on the first class? Yeah, they actually, Yeah. Let me just show that here. A second. Anyway, you'll find it. It's there. Yeah. Yeah, I tweeted it. Complimentary download, $99 paper value, limit 3 per ID for UMaine students. Any JI paper. I talked to them. I said, hey, you're sending me a copyright violation, And I got students, and these students will become asset managers, and eventually they'll subscribe to your journal. What kind of deal is that? Institutional investors, blah, blah. And basically, so here it is. As a thank you for his contribution, institutional investor journals would like to provide University of Maine with access to the Journal of Index Investing for the rest of the semester. So there it is. And that is UMaine logo right there. I mean, a little bit of a free lunch, as Adam pointed out. You still have to do a sign on, but I checked it out. It's real stuff. I mean, this is a very legitimate journal. But you can not only download my paper, but you can download other papers too. All PDFs, So if you want to, you can.
Is that not one of the ones in the library that you can usually get?
No. It's because these are practitioner journals, They're thousands of dollars for the annual subscription, or whatever be the reason. All right, let's see where we are. So anyway, that whole tangent was on this ETF's growth. That's why back in 2000, I started doing research on ETFs. They're theoretical reasons, that's what I'm saying. And there you go, see this name here. And I know I'm saying it again, but it's just being funny. Richard Roll questioned whether it was even conceptually possible to test the CAPM. That's called the Roll's critique. Roll showed it's virtually impossible to prove investors behave in accordance with CAPM theory. And so that's the Roll's critique. We're pretty much done here, so just hold on, 5 more slides. Here's the next big thing that is you will see. By the time you guys, next 20 years, you'll see that, 15 years. Work is already being done. Actually, work has been done by Roll and Ross. You can write down the name Ross if you want to. It's fine. And Thaler, Thaler. The CAPM is a single factor model. Steve Ross and Richard Roll of Dartmouth and MIT and UCLA, they proposed the APT, the arbitrage pricing theory, that the relationship between risk and return is more complex and may be due to multiple factors such as GDP growth, expected inflation, tax rate changes, and dividend yield. So what did they do is they took the single factor CAPM and extended it to multiple factors. So now beta is no longer just the sensitivity to the market is a sensitivity to any factor, where the market is one of the factors. So this beta 1 here could be the market beta. Beta 2 could be the beta on GDP, beta 3. What is interesting is these factors have yet not been identified. That's the next frontier. The APT is being used for some real-world applications. Its acceptance has been slow because model does not specify what factors influence stock returns. Remember the first project that I got in 1996? When I started work in San Francisco? How many factors did I have, variables I had in my model? 256, yeah. Is that quest to make gold from dirt, is there. There are people working around the clock, around the world, They're trying to, create that little green money tree there. They know that money tree is there, is green, but they know that the minute it grows, it gets arbitraged away and it dies. And the only way you can stay ahead is to keep planting new ones and different types because the climate changes. So the same tree, even planting the same tree is not going to work. You got to have different types of trees. So that's where research comes in. More research on risk and return models is needed to find a model that is theoretically sound and easy to use. And look at that. Here it is. I can show you. I know I mentioned it to you. My students remember that. I got a mail from Anna Zivanovic, who was my student in 2006. She remembered it. She took the initiative to send me an email, 2 emails, said, Pank, you were talking about Fama all the time in class. You got a Nobel Prize this morning. Just wanted you to know. Fama and French. Ken French is the other big hitter who will also get a Nobel Prize. He's from Dartmouth and Yale. They proposed 3 factors. One is basically the market return, but they just adjusted it, market return, excess market return. The second is called the size factor. And the third is the distress factor. And Officer Winslow and Mrs. Oman are going to discuss that in the value line paper, where they have those factors in there. Where the value line paper that I started working on in 1992 and finished in 2011 does a regression based on the Fama-French factors. Where basically it says, so you can read this, guys, but the upshot is this. Higher the market return, higher the expected return on a portfolio. Remember that. Lower the size of a company, higher the expected return. That's the second Fama factor of size. There's an inverse relationship between size and returns. My professor from 1991, Dr. Gupp, who sends me jokes nowadays that I cannot share in class. But he took me under his wing and he said, when you got on the board, I took you under my wing, so he's proud, He said, very simply, he said, think about it. You have a company like Microsoft and Apple. It's exponentially already grown up. Can it just double like that? Whereas a smaller company can become bigger in the same amount of time, a little bit easier than a mega company becoming even bigger. And that happened. Apple was $700, then it dropped to 400, and now it's back. But some of the smaller companies, they continue to go up. Google at one time was a small company. Dell was a small company. Microsoft was a small company. So that's your S. That's the second factor. And what is the third factor here, guys? That's called HML, high minus low. It's something called book to market. So if a company has a high book to market ratio, that means its company is distressed. Think about it. You guys are accounting gurus. I guarantee you, each one of you knows more accounting than me. If a company is distressed, that's it, General Motors. The price is literally 5 cents. 5 cents on General Motors, okay? So the denominator, which is market value, is price times number of shares. Market value very small, right? So market's saying, hey, I don't want to buy this company. It happened, right? I don't know if you guys know. You can Google it. You can actually see that the declaration of bankruptcy in 2008. Great company, one of the Dow original components other than General Electric, went bust. Just like that. Amazing, right? What was the point? Forgot. I was thinking of 2008. Oh, General Motors will have a very small market value, but the book value will still be there, right? If you take all of General Motors plant and equipment and sell them for scrap iron, it still has some value, right? So the book value is going to be higher than the market value. Now there's another complexity that is happening is what is the book value of a company like Google or Facebook? You know, I mean, it's literally like this, right? Some chairs and tables and maybe nicer furniture. That's about it, right? And computers. The value there is of people like you and me who are sitting there and working behind those screens. So you can't even there's no tangible capital. So versus the intangible capital. But anyway, high book to market ratio is indicative of financial distress. So I'm taking all the mumbo jumbo, all that. This. So the Fama-French three-factor model is what? When the market is high, your portfolio is going to be high. If your portfolio is populated with small company stocks, your return is most likely going to be higher than the benchmark. If your portfolio is comprised of companies that are distressed, your expected return on your portfolio is going to be higher. I mean, this is like dangerous stuff, guys. This is all non-intuitive. Can you do that? Would you like to do that? Think about it. In the end, the relationship is still between just one item. It comes down to risk. A high financial distress company is a proxy for a risky company. You buy Facebook at $19, it's at $38, you know, its book to market is going up. Small company is a riskier company, right? You think there's less risk in Apple and in Microsoft than in some other companies. So it all comes to risk and return. It's risk, return, and time. These are the three. That's why the book that I'm working on is not the fundamentals of investing and the philosophies of life. It's the opposite. It's the philosophies of investing and the fundamentals of life. This is actually the equation. This is all simple stuff. I'm not going to ask you like that in anything, but here it is. Here's your SMB, small minus big. And this is HML actually, high minus low in the book value here. And you can actually plug in numbers if you have some numbers. So the expected return on a security using the APT model is 8.9%. And for the CAPM is 6.3 times 0.9. You get that from here, 6.3.9. And so they don't have to converge, you know, but they should be. But if you think of it, if you're a security analyst, you will have triangulation. You have different ways. Then you use the dividend discount model, which we're going to do next, and you're going to have an estimate of that. And then that's how you value stocks or companies or assets, and not by looking at a graph. So folks, this concludes Chapter 5, Portfolio Theory. Let's have a break.